As rates rise, we're starting to see multiples compress, and these type of companies are still going to grow, I think, substantially in the 5 to 10 year time horizon. We are approaching a 1-year downtrend in this market. Now, when we look at the overall performance on the S&P 500, we're only down roughly 15%, but it's felt a lot worse than that. We're going to break that down right now. When we look at a per sector basis here, we can see that the overall index is down roughly 16%. But if you haven't had exposure to consumer staples, obviously energy, healthcare, or utilities, you are definitely down over 20% in this market, if not even more. And what are some of the top holdings in people's portfolios? Well, for Gen X's, we can see here that Tesla is one of the most popular holdings, along with Apple, Amazon, Neo, Disney, Microsoft, Nvidia, Netflix, Facebook, and AMD. Notice that there's no exposure to energy or consumer staples or even healthcare. If we scroll down to millennials investment profile, we can see here, once again, Tesla is the top holding. Another commonality, we do not see any sort of consumer staples or healthcare once again. Gen X's, same thing. And once again, with baby boomers, the only thing we really see a little different with the baby boomers is that they have AT&T in there, probably for the dividend. The funny thing about this is some of the videos that have been my most accurate are the least liked videos. And so the trend is that when people are talking about something, they're probably going to be wrong. And it's very similar to the investment that we've just seen. A lot of the stocks that everybody owns are down 50 and 60%. We take a look at Meta down over 64%, Tesla down over 46%, Nvidia down 44%. And when we take a look at what is outperformed, it's consumer staples, energy, utilities, and healthcare. When we line that up with the business cycle, we can see energy, consumer staples, defensive, and utilities is what we would consider late expansion to early contraction phase. This is normally when the Fed start tightening, inflation is running high, and we come to an end of a bull market and business cycle. We've been in this trend for about a year, which makes me believe we're about halfway through this tightening process that the Feds are doing, and we're about halfway through what we would consider a bear market until we get a market bottom. If we look at the history of the Fed's fund rate, almost every time that the Feds raise rates aggressively, we go into some sort of recession. We basically went from 0% rates and currently trading between 3.75 to 4% on the Fed's fund rate, with the Feds hoping to get closer to 5 or a little over 5%. Now, what I want people to really pay attention to is the fact that these hikes just started taking place, and it takes time for this to go through the system and for us to feel this as a consumer and for businesses to really be impacted by the adjusted rates. Real estate is impacted directly to rates, so we're going to see a slowdown in real estate before we see a true trickle-down effect in the economy. What you should pay attention to is not necessarily the size of the hikes that we're seeing here, but the fact that the Fed start raising rates and what happens, there's a delayed reaction to where we go into a recession and then they reverse monetary policy. Once again, they raise rates. It takes a little bit of time. We go into a recession and they reverse monetary policy. They raise rates. It takes time and we go into recession and they reverse monetary policy. Now the question becomes, are they going to reverse monetary policy if we go into a recession? And I think the answer is no. I think this is going to be a lot longer than people think. And the reason being is that recession is scary, but it is part of the cycle. What's more scary is not getting inflation under control. The battle for 2% inflation is much more dangerous than people understand, and it's really been the reason why I think 2023 is there's just no way around it. We're going to head into some sort of recession. And that's why when we line up what's performing well, what the Feds are doing, it's pretty clear that we're still in this early contraction phase as the Feds are about halfway done with monetary policy tightening. But what we have to think about is the fact that they're unwinding a massive balance sheet that's going to feel much like a hike once again. So even though they're getting rates to about 5%, it could feel like a lot more with the expiration of these assets that the Feds hold. So I still tend to believe we are still in this early contraction phase while heading into a late contraction phase and a possible market bottom. Therefore, my thesis is we're about halfway through a duration and halfway through a total percentage drawdown from the market, which means that I think that we probably have another 15-20% drawdown and probably another 12 months of pain ahead. Now, once again, this is just me taking the data and coming up with the best thesis that I possibly can by using what is outperforming and where we are in the economic cycle. Now, with that being said, there is a tremendous amount of opportunity, and there's a couple stocks I really want to hone in on. Number one is going to be BlackRock. Now, with real estate being impacted by interest rates, BlackRock has sold off significantly here. And there's been some bad news with liquidity crises within their fund. I don't think this is a long-term problem, but I think it is a short-term problem that's going to possibly cause a pretty significant drawdown in the stock and lend a pretty opportunistic buying opportunity for those that are willing to step in. Along with real estate, I do like the Meta play here. Now, there's two ways to really think about Meta, and I can come up with two drastic price targets. One price target is that Meta does work out, the metaverse is something real that we adapt to, and Meta explodes from a growth trajectory. The other side is that Meta burns a lot of capital and the metaverse never pans out, but this company is still a cash cow. And therefore, I tend to believe buying it on a dip opportunity at the right price makes a lot of sense for either or thesis on Meta. If you're a little bit more bullish on the metaverse, then I think right now is a tremendous opportunity. If you're a little bit more bearish on the metaverse, then I think you have to wait for that $75, $80 to kind of come through once again, as I do think that there's probably going to be an opportunity to see a significant drawdown in 2023 once we get confirmation of recession. The third one is obviously Google, which we've talked about a lot. Now, what do these companies have in common? The companies are all good run companies. They have strong balance sheets, strong free cash flow, and are probably not going to be as impacted as rates. As rates rise, we're starting to see multiples compress, and these type of companies are still going to grow, I think, substantially in the 5 to 10 year time horizon. So what you want to see is strong growth rates, strong free cash flow, and a strong balance sheet. This will absolutely weather any sort of storms in the long term and give a tremendous buying opportunity. I don't think you have to get cute in this market. I think the market's discounting some tremendous opportunities here on good quality companies. So you don't have to search for these 10x stocks because I think the market's just giving you a layup in some of these sectors. And these are three stocks that I'm personally keeping an eye on that I'm interested in, as I think there's some generational buying opportunities with a lot of these companies. Along with that, guys, you know I'm big on the chip makers, and that's another area that I'm looking at. But when we look at the economic cycle, I still think there's a little bit more pain for the chip makers, and that's why I'm pumping the brakes on them and seeing who really comes out of it, because the chip makers are getting more and more competitive, and there's a lot of political uncertainty with the chip makers. We are starting to see healthcare, consumer staples get a little expensive here. They're starting to get in what I would consider pretty close to bubble territory, where I could see them tick up a little bit further here, but have a pretty significant drawdown as they're getting fairly expensive. Now, there are some consumer staple stocks that I like that I've mentioned on this channel that I think are still cheap and are going to get cheaper, and I got my eyes on them as well. So when we think about how long, how much more pain is ahead, I think it's pretty safe to say that we're about halfway there. Now, I know a lot of people think that there's going to be this massive catalyst that causes a bull run, and the only thing I really think that changes the fundamentals of this overall market is if the Feds lower rates. Then we can pay a premium for stocks once again. Companies can borrow at 0% and get some sort of rate of return on it. I just don't see that happening, as I think the Feds understand that they have to unwind this balance sheet, that we have to get rates to a normalized level, and most importantly, that we have to get inflation under control. And the only way the Feds can do that is by demand destruction of wealth, causing the consumer to be scared to spend money, essentially. That will get supply chains under control. That'll get pricing power under control. And unfortunately, the only way I think they can do that is going to be a recession. As once PPI came out, we saw that PPI is still elevated, which tells me that the Feds really have no control over what companies are paying for goods. The only thing they have control over is affecting the consumer's wallet, as 1 in 4 millennials are moving back in with their parents because inflation is out of control. And these are type of behaviors that we're probably going to see take place more and more going into 2023. As always, guys, this is just my opinion, giving you the facts and maybe looking at some opportunities that are presenting themselves in the market. Is number one, does the company have a clean balance sheet? Number two, do they have strong free cash flow? And number three, are they going to maintain strong growth rates over the next 5 to 10 years? If the answer is yes for those type of companies, and they're getting discounted and de-risked, it's actually safer and safer to buy these companies when the prices come down. Even though people tend to sell when prices go down and buy when prices go up, you're de-risking the asset when prices come down, so you should be buying a lot of these dips. But human behavior is that they do the complete opposite. But these are some stocks that I think you really need to take a look at going into next year, especially if we still get this, especially if we're still in this bear market where the market's selling off. You want exposure to these companies that have a tremendous amount of opportunity, that are well run with clean balance sheets and strong free cash flow. Just my opinion. As always, guys, appreciate your time. Thank you so much for spending it with me, and we will see you in the next one. Peace.